Value at risk, or VAR, is a statistical tool used by finance professionals to estimate the potential loss on an investment portfolio. It acts like a risk thermometer, telling you how much money you might realistically lose over a specific time period. A common confidence level is 95%, which means you are confident that losses will not exceed this amount in 19 out of 20 cases. VAR boils down complex market volatility into a single dollar figure, helping investors understand their worst-case scenarios under normal conditions. While VAR measures day-to-day risk, stress testing looks at what happens during extreme, unlikely market crashes that statistics might miss. This chart shows how a daily VAR estimate might fluctuate as market prices change, keeping investors informed of their shifting risk profile. Remember that VAR relies on historical data and cannot predict sudden shocks that fall outside of normal market behavior. Understanding your risk metrics is a key step in portfolio management. Thanks for watching, and stay tuned for more finance basics.